Hi everyone, it's Jack back on another video. Today I'm going to be talking about Intel stock, which has just released its Q2 earnings report. It's been really positively received by the market, up 7% after hours so far. Could go even higher. I'm seeing a lot of news about how positive this has been received. It's had a really nice return over the since year to date, up 29% year to date, not including that 7% increase after hours. However, in the past year it's down nearly 13%. Over the past 5 years, it's been an absolutely horrible investment. Over the past 10 years, it's been a really horrible investment and has been thoroughly left behind by its competitors. Even still, it's getting towards 52-week highs. Leaves me asking the question, is Intel having a comeback, or at least is the stock having a comeback? So I'm going to analyse the Q2 report, analyse how it's doing versus competitors, look at its valuation, versus its own averages and versus the market, look at its outlook, and then decide whether I think this is a buy, sell or a hold. Let's get into it. Here's a quick look at the headlines before we get deeper into the individual segments. $12.9 billion in revenue, that's down 15% year over year, which is obviously terrible, but $900 million above the April outlook, which is a decent beat. 39.8% gross margin, which is again 2.3 percentage points above the April outlook, but still down 5 percentage points year over year. This gross margin has been continually eroded year over year. Very unimpressive gross margin compared to its competitors at the minute. Earnings per share of 13 cents, down 54% year over year, but significantly above the April outlook, which was predicting a loss. This is definitely significant. It's now much easier to value Intel again. It's hard to come up with a valuation, therefore, even if this stock is worthwhile buying, if it's not producing any earnings, considering how mature it is and how much capex it's got coming along in the pipeline. But to me, these are adequate results, but still, Intel is on a very steep decline, judging by these. First segment to look at is the client computing group, which is by far the largest segment and also down the most in absolute dollars. It's down $900 million, which is a significant decline. That's 12% year over year. But operating income was up 19%. That's essentially just off operating margin increase. Operating margin increased from 11% to 15%. So operating income was up from 900 million to $1 billion. Nothing to really shout about here. This level of revenue decrease is unimpressive, even if they're getting some economies of scale. They called it total addressable market contraction, essentially meaning that it's an unfavorable market for semiconductors in general at the minute. Other companies are not really seeing that. OEM inventory reductions, operating income is higher on reduced spending and inventory reserves. Overall, this is poor in my opinion. Next, the data center and AI group, which pretty much every other manufacturer of these types of things are seeing big increase in the AI segment, and they are seeing a CPU TAM contraction and competitive pressure. Competitive pressure mean competitors are doing a better job selling their products than Intel are, and TAM contraction, just not really seeing that, and other competitors aren't really seeing that, so I don't really buy that, other than the addressable market for Intel products is down rather than the addressable market for data center and AI products. Revenue down 15%, $700 million, which is absolutely significant. Operating margin, the loss expanded from $100 million to a loss of $200 million. This is very significant. These were previously very cash generative. Don't really know how they're going to generate any margin in the future and generate any cash to pay for the numerous projects they've got, with the two biggest groups and biggest segments by far doing so poorly. Next, the network and edge group. This was then revenue down massively, not in absolute terms compared to the other business segments. Revenue down 38% year over year. Lower edge and telco demand, which I actually do believe softens in this demand, and elevated network inventories, meaning customers are not having to buy as much. Operating income was down due to reduction in the economies of scale, down 164%. So swung from $300 million of profit, of operating margin at least, to a $200 million loss. Really, really unimpressive. And across the board, Intel, in terms of actually making profit, which is what these type of businesses are supposed to do, is doing a very, very poor job of it. Aside from the business making a pretty puny profit, the only real bright spot for me was Intel Foundry Services, which revenue was up 307% year over year. This is going to become an increasingly larger part of the business, even if it's producing just $232 million of revenue for the quarter. This is scaling up at a rapid rate. Operating income was a loss here, but it's acceptable here because this is a business segment that's going to require a lot of cash. Mobileye, which I've expected a lot from the self-driving segment, which it's spun off a large portion of it but still retains a very large holding. Revenue roughly flat year over year for a business that is well valued in my opinion, multi-billion dollar business that is producing very low operating margins and little to no revenue growth. Operating income down 32% year over year, margin from 41% to 28%. Very unimpressive in my opinion, and I was expecting a lot more from mobile. This is a disappointing turn of events for this side of the business. The outlook for the next quarter was better, but not particularly impressive. They're expecting revenue to be down 13% year over year and to be roughly flat at the lower end, or $1 billion of increase. We'll see how that comes off. 43% gross margin, that's down 2.9 percentage points year over year, but a 4% increase from where we were this quarter, which was a surprise on the upside. And 20 cents of earnings per share, which will be down 46% year over year, but a decent increase from the 13 cents for this quarter. Overall, this is the start of a turnaround for Intel, perhaps, but still they've lost so much ground on the rivals. It's only going to be a turnaround from a very poor business to a mediocre one by the looks of it. Full year earnings for this business, even the most optimistic of analysts will not be predicting more than $1 of earnings per share. So while it is possible to value this business based on its earnings and cash flows right now, it's still not really worthwhile. So based off next quarter results, it may do 80 cents for the year. And that would be optimistic in my opinion, possibly $1. That will put it at 34 times current earnings. That is an extremely overvalued business in my opinion. Analyst expectations haven't really caught up with the graph, but look at its 5-year average of around 11, its 5-year average to cash flow of around 7, 8. This is an extremely overvalued business right now. I think this run up is not really justified, and like I said, I think this is a business that is very poor going to a mediocre business. It's still far behind its competitors, has a ton of capex to spend. It's not going to be able to repurchase shares or pay a consistent dividend. I'm not really seeing any upside here at the current stock price. Perhaps at $20, $24, there was some upside, but right now at $35, this is extremely fully priced in my opinion, if not significantly overvalued. That's really the summary for me. I think this is going from an extremely below average investment opportunity to about an average investment opportunity, and it's not even there yet. The 30% run up is extremely unjustified in my opinion. Its current stock price, even with optimistic earnings expectation, will be around 30 times forward earnings, which is far in excess of what this business deserves, considering all its revenues are going in completely the wrong direction. Even if they are decelerating in their decline downwards, I still think this business is going in absolutely the wrong direction, while its rivals are outstripping its growth, and it still has a ton of capex to do to produce its fabs that it needs to do. And while it does benefit from things like the CHIPS Act and obviously onshoring of semiconductor manufacturing, decreasing globalization, there's still going to be a need for the absolute most leading edge chips, which Intel just cannot produce at the minute. They're produced by TSMC and to a lesser extent Samsung. For the best data center and AI chips, you're going to go to Nvidia and to a lesser extent AMD. Intel just can't compete with these companies right now, and I can't really see a point in the next 5 years where it is competing with them on an even keel. So with that being said, this is just my opinion. I'll be happy to be proven wrong here. Have invested in Intel in the past and got burnt, decided it's not for me. I think this is a business that has an extremely high level of difficulty in its turnaround. I think my investment dollars are best put in one of the other 4 companies that I've mentioned, because they're all doing a much better job of selling semiconductors than Intel is at the minute. Of course, that's just my opinion. I'm not a financial advisor. You should do your own research and due diligence and let me know what you think in the comments down below.